Imagine two people walking into the same dealership on the same day, both looking at the exact same car. Both choose a vehicle worth $40,000. Both have similar incomes, and both can comfortably afford the monthly payments. 3 years later, though, their financial outcomes look very different. One person ended up spending thousands more than they expected. Another quietly kept the cost of ownership as low as possible. And a third discovered that the option with the lowest monthly payment wasn't actually the cheapest choice at all. Most people think buying, leasing, or financing a car is mostly a lifestyle decision. Some people prefer owning, others like driving a new car every few years, and some just want the lowest monthly payment they can get. But underneath those preferences is a much more interesting question. What does it actually cost to drive a car? Because once you start asking that question, you realize that many decisions made at dealerships are influenced less by math and more by marketing, psychology, and the way the options are presented. And when you run the numbers, the differences can be surprisingly large. So in this video, we're going to break down the 3 main ways people get a new car, compare the financial impact of each one, look at the incentives behind what dealerships recommend, and explore the psychological factors that often matter just as much as the numbers. To start, let's define exactly what we're comparing. The first option is buying a car outright. This is the simplest approach. You pay the full purchase price upfront and immediately own the vehicle. There are no monthly payments, no interest charges, and no financing agreement. The second option is financing. Here, you make a down payment and borrow the rest. The lender charges interest, and you repay the loan in monthly installments over a set period. Once the loan is fully paid off, the car is completely yours. The third option is leasing. Leasing works very differently because you're not paying to own the car. You're paying to use it during the period when it's expected to lose value. At the end of the lease, you usually return the vehicle and walk away, unless there's a buyout option. At first glance, all 3 options can seem reasonable. And that's exactly why this decision causes so much confusion. People often compare monthly payments instead of total costs. The problem is that monthly payments can hide what's really going on underneath. To see why, let's use a simple example. Imagine a new car with a purchase price of $40,000. For simplicity, assume a 3-year ownership period and a 15% down payment. If you buy the vehicle outright, the cost is easy to understand. You spend $40,000 today. Now assume that after 3 years, the car is worth about $24,000. That means it lost $16,000 in value, so your 3-year cost of ownership was roughly $16,000. This is the first hidden reality many people miss. The biggest cost of owning a car is usually not maintenance, it's not fuel, and it's not insurance. It's depreciation. The moment a new car leaves the dealership, it starts losing value. For many vehicles, depreciation is the single largest ownership expense. Now let's look at financing. Suppose you put down $6,000 and finance the remaining $34,000 over 3 years at an 8% interest rate. Your monthly payment may seem manageable, but over the life of the loan, you'll pay several $1,000s in interest. Meanwhile, the car still depreciates exactly the same way. The difference is that now you're paying for both depreciation and financing costs. If the car loses $16,000 in value and you pay another $4,000 in interest, your total economic cost rises significantly. This is where financing often creates an illusion. Many buyers focus on whether they can afford the payment, but affordability and cost are not the same thing. A payment can fit comfortably into your budget and still be an expensive decision. Dealerships know this. That's why conversations so often revolve around monthly payments instead of total ownership costs. The lower the payment sounds, the easier the deal feels. But that doesn't necessarily mean you're spending less. Now let's turn to leasing. This is where things get especially interesting. A lot of people dismiss leasing right away because they don't own the car at the end. Others love it because the monthly payments are usually much lower. Both views contain some truth, but neither one tells the whole story. When you lease a car, You're essentially paying for the part of its value that disappears during the lease term. If a $40,000 car is expected to be worth $24,000 after 3 years, then about $16,000 of value has been used up. That depreciation is the core of the lease calculation. As a result, the monthly payment often looks much lower than financing. For someone focused on monthly cash flow, leasing can look very attractive. But here's the trade-off. At the end of 3 years, you don't own anything. The cycle simply starts over. You either lease another car or enter a different agreement. And that leads to one of the most important ideas in personal finance. A decision can be efficient in the short term and expensive over the long term. Over 3 years, leasing may look competitive. Over 15 years, repeatedly leasing car after car can become far more expensive than owning vehicles for a longer period. That's one reason the answer to the leasing question is rarely universal. It depends heavily on your time horizon. The longer you keep a car, the more ownership tends to make sense financially. But the story doesn't end there, because numbers alone don't explain why certain options are pushed so hard. To understand that, we need to talk about incentives. When customers walk into a dealership, they often assume the recommendation they receive is designed mainly to help them. In reality, dealerships are businesses, and like any business, they have financial incentives. Those incentives don't always line up perfectly with the customer's goals. A financing deal generates interest revenue. A lease creates the chance to keep the customer coming back. The buyer returns every few years and enters another transaction cycle. That means recurring business. From the dealership's point of view, repeat customers are extremely valuable. That doesn't mean leasing is bad, and it doesn't mean financing is bad either. It simply means you should always evaluate recommendations through the lens of incentives. Whenever someone is selling you a financial product, it's worth asking a simple question. How does this arrangement benefit them? Understanding incentives often reveals what marketing materials leave out, and this applies far beyond cars. It applies to investing, insurance, mortgages, and countless other financial decisions. The next layer of this discussion is opportunity cost. Suppose you have enough cash to buy the car outright. A lot of people assume paying cash is always the smartest move, but that isn't necessarily true. Every dollar used to buy the car is a dollar that can't be invested elsewhere. If that money could earn a strong return in investments, a business, or another productive asset, then the comparison gets more complicated. That's the hidden math many people ignore. The real question isn't just whether financing costs money. Of course it does. The question is whether your cash could earn more somewhere else than the financing would cost you. Sometimes the answer is yes, sometimes it isn't. The right decision depends on interest rates, investment opportunities, risk tolerance, and your personal situation. That's why broad financial advice often falls apart when you look closer. The math can be different for everyone. But maybe the most overlooked part of this whole conversation has nothing to do with math. It has to do with behavior, because personal finance is rarely just about optimizing spreadsheets. Think about two different drivers. The first keeps cars for 10 years or more. Reliability matters more than image. They don't care about the latest tech package or a fresh new design. For this person, owning a car often makes the most financial sense. The second driver loves driving newer cars. They enjoy modern safety features, updated interiors, and manufacturer warranties. They hate surprise repair bills. For this person, leasing may offer real value beyond the numbers. The mistake happens when people confuse personal preference with financial strategy. A car is usually not an investment, it's a consumption asset. Its job is transportation. Understanding that difference can dramatically improve financial decisions. Too often, people justify expensive car choices using investment language. But the economics usually tell a different story. Cars consume value. Investments create value. Knowing which category an asset belongs to removes a lot of confusion. So, should you buy, finance, or lease a new car? The answer is less dramatic than many people hope. If your main goal is to minimize long-term cost, Buying outright or financing a car you plan to keep for many years will often give you the best outcome. If you care more about keeping monthly payments low and driving a newer vehicle regularly, leasing may be a reasonable choice, even if it costs more over time. And if you're considering financing, don't look only at the monthly payment. Look at the total amount you'll pay over the life of the loan, because the most important lesson here isn't really about cars. It's about understanding what you're actually paying for. Most financial products are designed to emphasize the visible costs and hide the invisible ones. The visible cost is the monthly payment. The invisible costs are depreciation, interest, opportunity cost, incentives, and long-term consequences. The people who consistently make better financial decisions aren't always the ones with the highest incomes. They're the ones who learn to see those hidden costs clearly. And once you start looking at financial decisions through that lens, buying a car becomes more than just a transportation choice. It becomes a lesson in how money works.